Hey everybody, good to be here today. My name is Brent Moore. It's time for Advanced Options Strategies. Each week we deal with different option strategies, and this week we're going to go towards maybe a little bit more of the more complex end of the spectrum. That's okay. I'm going to take you through it, and I think it's an understandable strategy if we go through kind of one step at a time. Specifically, we're going to be talking about long butterflies today. We'll be doing that next. I think it's appropriate for this market because it's kind of a high vol strategy. So we'll do that. Now, along for the ride with me is Mr. Cameron May helping me out. Cam's a longtime instructor, very knowledgeable in the area of options and trading, and he's a good guy too. As you have questions, feel free to type those in the chat between Cam and myself. We'll do our best to help you out with those. Also, you can follow either of us on X. Actually, follow both of us on X. At Brentmore CS, at Cameron May CS for additional content throughout the week. And there you go. Let's hit up your disclosures before we get into the main subject here. Options do carry a high level of risk and are not suitable for all investors. Information today is for general informational purposes only. Should not be considered an individual recommendation of any security strategy or chart type. Paper money application is for educational purposes only. Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risk, including the risk of loss. Let's see. Short options can be assigned at any time up to expiration, regardless of in the money amount. And that's certainly relevant for today's strategy because we're going to have short options. And for the most part, they're probably going to be pretty close to being near the money or in the money. But just realize that any trade that we show is just an example. It's not a recommendation. So what I want to do is I want to take a brief look at the market. If you want a more in-depth look at the market, check us out at 4 o'clock Eastern time today. We'll be teaching market movers. I'll be teaching that class, and I'll take a little bit more in depth at what is going on in the market. But in the meantime, this is the S&P 500. You can see we've had actually a relatively decently up day here, up 1.8%. In normal market conditions, 1.8% would be a very big day. Like if you look at this candle right here and compare it to most of these candles, it's way bigger. That's a huge day, but it kind of like pales in comparison to what we've been seeing lately in the market, which is, I'm kind of happy to see a little less volatility, to be honest. If you look at the whole shadow of the candle, including the wick, basically the whole candle, today's less than yesterday or the day before or there. I guess you'd probably have to go back here, but there you have gaps on that one. So where's this going? I don't know. I mean, in terms of like support resistance, I'd say this would probably be kind of a key level right there. That's where our low was. Our low was before we started doing the whole gap down deal there. So that'd be kind of a key level to break through, I think, on the upside on that. On the downside, well, certainly the low that we hit, that would be kind of a key break on the downside. That's presumably a little bit of a support level there. Now, there's other things you can look at. We can do trend lines. We can do moving averages and whatnot. If I were to do just kind of a standard trend line, I'd probably kind of do something like that. Again, that's a potential resistance level there. So that's where we look. The other indexes aren't that dissimilar from the SPX. And again, we'll hit that up at market movers at 4 o'clock Eastern time today. So let's go and let's talk a little bit about long butterfly spreads here. And what I'm going to do is I'm just going to bring up a document here. I'm just a blank document, and I want to talk about long butterflies. So let's just kind of title this. And so what I'm going to do is I'm just going to give you kind of some just kind of a quick data dump, if you will, on this, on kind of rules and the basics of these, and then we'll go and I want to look at real life kind of examples of what this is gonna look like. What is a butterfly, okay? They can be calls or they can be puts. And if they're calls, they're going to be, basically, it's a long call vertical plus a short call vertical at the same time, okay? Or if they're puts, they're long put verticals plus, supposed to be a plus sign, plus short put verticals at the same time, okay? Same expiration date too, if I can hit my shift key there. So that's what they are. But you got to kind of get them in the right order of one another. So what you're going to do is you end up, and this is how I normally think about them, more so than the long call vertical, short call vertical thing, is I think I sell two contracts at the middle price. And for balanced butterflies, which is typically what we look at, and I'll try and look at both a balanced and unbalanced one today, but you'll have kind of an equidistant between the wings, and on each of the wings, you're going to buy one contract higher strike and buy one contract lower strike, okay? So how many, four total contracts here on this, right? Or some multiple thereof. I mean, we could do 4 at the middle price and 2 higher and 2 lower, but those are two short contracts, 2 long contracts. So that's how they're constructed there. And we'll look at one. We'll go through examples here in just a sec. But this is, in a sense, it's a non-directional trade. We're targeting the middle strike. So you can make it a little more directional, pick a higher strike than where the stock currently is, and you just made it a bullish trade. Pick a lower strike, you made a bearish trade. But in general, we're going to call it non-directional, okay? So it's a positive theta trade, okay? Time decay works in our favor. It's a negative, and this is the key, negative Vega trade, and that is important, I think, for our current market, because, you know, when we're looking at the market, let me just pull up the VIX here real quick. Here's the VIX. When we're looking at the market, those are high volatilities. Now, I don't know how long implied volatilities are going to stay. You know, we're up near 40 right now. I don't know how long they're going to stay up in that realm. You know, it's indefinite. We don't know, but typically implied volatilities are mean reverting, so probably expect them to come down at some point here. Because, you know, if you just look at a chart, here's a 3-year chart of the VIX. When they spike, they don't tend to stay up super long. Well, this may stay a little bit longer. This is a different, unique circumstance we're in. But if your expectation is implied volatility is coming down, then this is a strategy that may make sense. Now, you're balancing implied volatility is coming down with the whole non-directional thing. So right now we have a lot of volatility in the market. If the market moves a lot, then that's going to hurt us from the directional standpoint. It'll probably also hurt us in the fact that it'll probably keep implied volatilities up pretty significantly. Okay, and so the center strike, I think I already said this, is the target price. Price. All right, and if you want, you guys, I can't send out this doc, but if you want to, you know, take notes or do a screenshot or whatever, you're welcome to certainly do that. Okay, what about those outside strikes? Because you're picking a higher strike price, you're picking a lower strike. How do you decide what strikes you're going to pick? Well, the way, I guess, we think how to word this, outer strikes are where you think stock will remain, okay? So if I have a $50 middle strike and I think the stock is likely to go, you know, kind of in the range between 55 and 45, I may do my outer strikes at the 55 and 45 level, okay? So that's how you're going to typically pick those outer strikes. And you may tweak them a little bit, and we'll pull up a trade, and then you can always that's the thing with the Thinkorswim platform. Pull up the trade, look at it. You can look at the risk profile tool, see what it looks like, and then tweak as necessary there. The probability, well, let's see. A probability and reward to risk, it depends on strikes, okay? The strikes you choose. But in general, I would say this, because a lot of times people ask me about like long butterflies versus, say, iron condors. Iron condors are also positive theta. They're also negative vega trades. Long butterflies are generally lower probability trades. Okay. Now, so if you compare them to that iron condor I mentioned, lower probability, probably a higher potential return on those, but that may guide you on when you decide when you deem that going to be appropriate. Generally, when we do these, we're going to buy 20 to 4, and this is just a rough guideline for this class. Of course, you can go longer or shorter term, days till expiration. Okay, that's another thing, another kind of rule that we're going to follow here in this class. Now, let me just mention this. This is called a long butterfly, and it's going to initially be, if it's a balanced situation, in other words, my strikes are equidistant from one another, it'll be a debit spread. It's going to cost you something. That's what we're calling it, a long butterfly. If I start to switch this to a unbalanced butterfly, it may actually generate a credit instead of a debit. And I'm going to show you an example, I think, of that later as we go. We'd still probably consider it a long butterfly. So if you're selling those two middle strikes and you're buying the outer wings, we're going to call that a long butterfly, even if you get a credit. Even if you get a credit on that. Okay. One other thing. Okay. So the max gain, I said, it's generally a lower probability trade, but a higher reward trade. But that max gain can be tough to hit. Don't plan on the max gain would be my take on that, because if you look at the risk profile, and we will do so, when you look at them, the max gain is a peak. It's like a little tint. Okay, one little spot there represents our max gain. So the odds of hitting that exactly probably pretty slim there. Okay. So let's go. I have a couple more little notes here that I wanted to make sure I didn't forget anything on. Oh, exits. Let's talk about exits. Okay. So because that max gain, so this goes right along with this other one, we're not going to insist, we're not going to wait for that max gain to be hit. In this webcast, in this example, we're going to exit at a 50% gain. 50% of max gain is going to be an exit for us. Okay. Of course, you may tweak that a little bit in yours, and that's not a universal truth you need to follow on that or whatever. But that is what we're going to do in this class. We're going to exit on a technical breakdown. Remember, this is more of a neutral trade. So if we break down, when I say break down, I don't break up, break down, I don't care. If it goes against us significantly so that we're no longer neutral on this, we're going to get out. If you don't want to do that, if you want to put that based on the option price, you could do like a 50% stop or something. Could do 50% stop. And then I think I have one more, two more, and then we'll get on and look at it. Exit less than 10 days to expiry. Okay. And then finally, money management, 1% of portfolio. Okay, Leo. All right, so there we go. Under a number of, did I meant to hit, not high? Let's see. Can be tough to hit. Yes, it can. I meant hit. Okay, so thank you. I'm sorry when I'm typing. Well, look, I'm not the greatest typist in the world anyway, and I end up doing mistypes anyway. But it's a little harder when I'm trying to go quick. There you go. Those are kind of the essentials of what we're doing here. Let me show you an example. Let's go here, and I'm going to go to the scan tab, and I have butterflies up here in the spread book. So this is just the ISE spread book. So these are actually trades out there in the real world, and let's just kind of look at them. Let me just make sure I want something that's going to be equidistance. So let me analyze this trade, and we'll take a look. Why did that not come up? Let me get rid of, I have VIX up on that. So what are we doing? We're going to try this. It's Rivian. Is that Rivian? Yeah, Rivian. Let's analyze this trade. There we go. So this is what it looks like. Okay. This is what it looks like. Absolutely. Okay. So when I mentioned earlier that it kind of comes to a peak, this is what I mean. This represents our max gain right there. You see why I say don't bank on getting that max gain, because reality is you're probably not getting there to that max gain. It's probably not going to be exactly that. When I say it's a look at your reward to risk. Well, look, I mean, the reward is the difference between our break even, which is down here, and that's a big gap there. Our risk is only this. But given this trade, that this is just somebody's trade, this isn't our example trade. We'll look at our example trades here in a minute. But if you look at this, it's going to be a pretty narrow, our break evens, our probabilities probably aren't going to be great in this, is what I'm trying to say. Let me go and just do break evens, set slices, break even at expiration. There's only about a 12% chance of this being at break even or better on this trade. So this is kind of an extreme example that this person did on this, but let me just make sure there's nothing. Oh, I got two of those on there. Let's do that. Okay, same thing. I just had it twice. So low probability. In our trades, we're going to look for something that's probably higher probability, okay? And the disparity between the max gain and our max loss is not going to be so great, although it still will be probably a lower probability trade, and we'll still have this same pattern right here. Now, notice, we have a break even right there. We've got a break even right there. Where are those break evens? The break evens are going to be right at our long strikes. Okay. So what? Oh, actually, that's not where the break evens are. Sorry. The break evens are going to be our long strikes are going to be where our max loss, occurs on those. Okay. So that's why when I say when you're creating those wings there, and there, that's why we want the stock to stay within the range there. Okay, so let's go. That was just kind of an example off a trade that just somebody else was doing. But let's go to our own examples here. And look, it's a tougher market right now in terms of finding stocks that you think maybe are going to be more sideways. Also, we have a lot of earnings coming up, don't we? Like if I look at here's a watch list. Doesn't matter what watch list you're using. Let me go to S&P 100. Okay, public S&P 100. The ones with the blue circle, red telephone means they have earnings coming up. Look at the sheer number that have earnings coming. Earnings season kicked off today, so it's hard to avoid that. That provides some advantages. Implied volatilities are higher, right? But some disadvantages. There's a lot of uncertainty that comes out with earnings. So that's a challenge. But let's say I'm going to take more of a neutral take on this one here. Okay, I'm going to say this is going to be a little bit more of a neutral. This has had a big rundown. The market's had a big rundown. The assumption for this trade is things are going to settle down here. I don't know when they're going to settle down, but that's the assumption for this trade. What you may want to do, though, is look at the implied volatility. Here's your implied volatility on this. Now, I don't have earnings for a little while on this. Earnings is on let's say we got late February, March, April, May. Probably late May is when we have our next earnings on this. So we got a little while on earnings. Doesn't mean implied volatilities can't be high, though, right? Just that's not because of anything CRM's doing, probably. It's more just, I would suspect, attributable to the market as a whole. So there we go. If the assumption is this is going to go down, that is only going to benefit our trade. Right now, our stock is around 254. I'm going to assume we're going sideways on this. Therefore, I'm going to do a strike around, well, we'll say 255 probably, if we have a 255 strike. And then we'll go out, probably I want to go down to, where's my low? My low was 230, right on the nose, 230, right on the nose. And so I'm going to do I am assuming that's going to act as a support level. Okay, that's my assumption. I'm also going to assume that, well, we have maybe some resistance up here around 275 or so, but that's going to be, so we'll put our wings there. We'll call that a wing, W, wing, and this is going to be our center, our middle, around 255. Let's take a look at this and see what this looks like here. Let me go to Trade tab. Let me go to, now, we said 20 to 40 days till expiration. Here's May, here's 28. This will be kind of split the middle, split the difference in there. I'm doing a call. Stock's at 254. I'm going out of the money a little bit. I'm trying to keep those short strikes out of the money because it lowers the chance of early assignment. It lowers that chance of early assignment. You can do a put, and the put is going to look very similar in terms of the reward to risk, in terms of that risk profile. But generally, just kind of as rule of thumb, we're doing these out of the money to try and help us with that. Okay? So let me go. I'm just going to click on butterfly. Now, don't worry about what the wings are here on this. Okay? And I'm going to look at that 255. Click on right here. Okay. Question from Ian. Do I look at the beta of the stock? And for those of you who aren't aware, the beta is just basically how much does this stock move in relationship to the S&P 500 is kind of essentially what that is. No, typically I'm not looking at the beta on this. On CRM, I'm expecting the beta is relatively high on that. You can look up here. We got our fast beta, which is basically the beta over the last year, 1.2, okay? So there's your beta on that. But is that a fact? In my mind, that's probably not an essential thing. I'm looking at the charts. I'm doing the technical analysis. I'm considering technical analysis, support, resistance, trend, the lay of the market in general. Maybe not beta. But look, I'm not saying you certainly could use beta on there. So good question there, Ian. Appreciate that. Okay. So here's this, but I'm going to put those wings out, and we said the lower wing was going to be 230. And I'm going to keep this equidistant, so that's what, $25 there. So 25 plus 255 is 280, right? 280, there we go. And let's just analyze this trade, okay? So here's CRM. This is what we look like right now. And so there we go. Now, there's the kind of tent-shaped deal we got there on that with the max gain. And notice, just like before, we stand to gain more than we stand to lose, but but it's not as big a gap as what I had before there on that. So that's just because my wings are wider. So there we go. Let's do this. And let's pull up our probabilities on this and just kind of see. Again, I'm expecting kind of a lower probability trade on this, but let me just get my, let's see, May 10th is where I want that. I'm going to set my slices to break even. And here we go. So about a 40% chance of, break even or better. And that's why we do technical analysis. If we just purely just go based on the probabilities, this is a lower probability trade. If indeed the support level we said counts for something, or resistance levels count for something, that should help us out, hopefully. And so there's that. Also, remember, we also have a better reward to risk on this than we have. Better reward to risk than if we're not, if that helps to make up, I guess, for the lower probability of success. Let's see, questions in the chat. Such a jittery market, would you look at a delta of 15 or less for wings? Here's what I'm doing on the wings. It's a good question, because a lot of times what we say is, when we're trying to pick strikes, we can look at the deltas for probabilities as kind of a substitute for probabilities, and an approximation, and pick our strikes there. You can adjust that. You can look at your strikes. I'm just doing based off technical analysis here. If I look at the 230 strike and the 280 strike, let's just see what our deltas are on here. Well, let me go to delta. I'm not really even sure what these are going to be. 230, 280. We had about a 21 delta on that. 230, about 21, just by coincidence, the same thing. So you could, Bridget, I don't think that's necessary, but you can certainly do that, okay? I mean, in theory, these probabilities take into account the implied volatilities here in the market, okay? These take into account the implied volatilities, and therefore, so this kind of adjusts us for that, okay? So what's our max gain? Our max gain is about 1770. I'm just going to jot that down because we said we may get out at about half of a max gain. 1770 divided by 2 is $885. So now, before I go on with this and place a sample trade, of course, do your technical analysis. We did that quickly. Make sure you feel free to tweak this. You can switch our strikes up on this if we want. And we can go, well, what if instead of 230, we could look at the 225 and the 285 or something like that? And you can see what's the initial, how does that affect the initial debit? How does that affect the probabilities there? Okay. So is there another way to make this a higher probability trade? Well, look, we can tweak this and see. Let's see if we go to 225, 285, and let me click on this. Instead of 40%, let's just set our slices to break even and see if this makes it a higher probability trade. That increased the probabilities there a little bit. So good question from Journey in the chat. Yeah, you can play with this, but the reality is this. In my experience, if you're looking for a high probability trade, this is probably not the strategy for you. So that increased the probabilities a little bit, but it also, there's no free lunches out there, folks. It also increased our potential loss on that trade to 1038. Okay, so that's that. Now let's go back to trade. Let me get back and bring that trade up here. And let's talk about exits here on this. So what I'm going to do is I'm going to do a first triggers OCO order. I'm going to just right click on this. I'm going to create an opposite order, one to get out. We'll do a couple of those. So I have two to get out. This is to get in the trade. We said we want to get out if we hit 1/2 of our max gain. We calculated our max gain at 885. The initial debit is hold on. It's moving around, 724, okay? That's my initial debit, and it's moving, but I'm going to take, if we buy it for $724, that means if we sell it for $724, that's no gain. That's break even. But if we sell it for $724 plus $885, that gives me $1609. If I sell it for $1609, that represents the 50% of our max gain. Okay, I'm going to sell that. I'm going to put in good till canceled, and that's our target price on that. Okay. For our exit, what I'm going to do is I'm going to say, well, I'm going to exit if we break below that level on the chart. We said that low 230 was going to be our support level on that. So if we break below that, we're going to get out. So what I'm going to do here is I'm going to click on market, good till canceled. I'm going to go to my gear, and I'm going to go down here under where it says symbol method trigger threshold. I'm going to say if CRM marks less than or equal to, this is looking at the underlying stock, $230, it's going to get me out. I'm going to save that, and let's just take a look. There's my mid price. Let me move up just a little bit to see if we can get filled on that. This is going to go in my butterfly basket right there. That was 50%. 1772 was the 100%, Chris. Chris, it's a good question, and I know I went a little fast on that, and I tweaked my trade down here. Let me get rid of this trade. Wait a second. Yeah, we're getting rid of this. This was the trade. Our max gain was 17. It's moved a little bit. It's now 17, close to 1750, basically. So we did about half of that. So for those of you wondering, how did I get that again? Let me just review that real quick. I took my max gain. I just looked here on this. I divided that by 2. It was 885 at the time. And then I looked at my initial debit and I added it to my initial debit. That gave me 50% of my max gain. Thank you, though, for checking me on that, because I'll tell you, more often than not, when you check me, I realize I was going too quick and I made a little mistake on that. So there's that. And Kurt, you see, there we go. Kurt said, what about the high side? Well, that's a good point. I didn't put anything on the high side. I'm going to have to reevaluate that. Let's do this. On the high side, I meant to do the same thing. And 230, or we said, I was going to say, if it breaks above, well, this, I'm going to call this as kind of a resistance here. Thank you. I was going too quick on that and trying to talk. Around 273 was my high there on that. I was going to use that as a resistance. So if we break above 273, I'm going to get out. I'm going to, this exit area, let me right click, and I'm going to cancel and replace that. I'm going to go here, and we said CRM marks less than or equal to 230, or if it marks greater than or equal to 273. So thank you for, oops, it's supposed to be 273. Thank you for that there. So that's the high side, okay? And we'll send that. All right, so we just replaced the other one there. Okay, now, what I gave you was a example of what we call a balanced butterfly, Notice we had that middle strike there, okay? We had a middle strike, and our gap on the high side and the low side were equidistant there. They don't have to be. Now, what does that do? It changes the whole thing. It changes the whole equation here. Let me give you another example. And this is one I actually saw someone do. It's not the exact same prices or anything, but it's just one that I saw done the other day. And this was on MasterCard. Okay. And the theory on this one is, again, we're kind of mellowing out. I'm going to do a put butterfly on this, but I'm going to make this an unbalanced butterfly. And the theory is this, and by the way, you can see the implied volatility down here on this one. The theory is implied volatilities go down. In fact, I meant to show you on the let me show you something here on this. Okay, let me go back to CRM for 1 second, then I want to show you something on that implied volatility there. If the implied volatilities change, I want you to take a look at this purple. Let's do this, okay? Let's just look at the current price. Okay, we just go 0 offset. Okay. So we're actually on a minor profit right now, but look at what happens if implied volatilities indeed go down. If implied volatilities go down, we'll say they drop 10% on this, okay? Minus 10, minus 10, we're just kind of modeling this, and minus 10. Okay. Look what has happened to our profit loss. The profit loss has improved. If implied volatilities drop, our profit loss gets better. So you can model that on here if you want. Go to your charts and you can say, well, my implied volatility on CRM was 47. What if it goes down to a more normal level, kind of down here to 37 or something like that? There's your 10-point drop in implied volatility on that one. What about MasterCard? MasterCard, we have a fairly high implied volatility. Right now it's at around 43. What if it drops down to about 28 or something? That's only going to benefit our trade. That is why on these trades, we call them trades that are more appropriate for a higher implied volatility environment. Now, that doesn't do me any good if the stock moves a ton, because this is more of a neutral trade. But we can modify that and make this a little less neutral. We can kind of protect ourselves on one side or the other. Chris said, so the opposite is true if the IV spikes. Yes, if the IV spikes, if the IV went up 10% on these, I'm just using 10% as an example number. Would that hurt our trade? Yes, darn right, that would hurt our trade if implied volatilities spike. This is a negative Vega trade. So here's my theory on this one. My theory on, and this is gonna be a tweak. This is a little bit more advanced, but we're gonna say, you know, this is kind of a likely area we're in. Okay, so I'm assuming this may kind of drift in this area. Now I could do a balanced butterfly with the 500 as the center strike if I wanted to. Or I could skew this and say, you know, maybe this is this, but maybe it goes up quite a bit. Maybe we could protect ourselves by skewing this butterfly a little bit here, okay? So we're going to unbalance the butterfly. So let me give you an example here. Let me go to the Analyze tab. We're going to go to MA. Let me go to Add Simulated Trades. I'm going to go out and when's our earnings date on this? Let me just double check earnings. April 30th, end of the month. Okay, so I'm probably not going to want to be on it. I'm not going to hold through earnings, although that would benefit us from the implied volatility standpoint, likely, not necessarily, but likely. But I'm going to shoot to get out. And remember, we're going to shoot to get out within 10 days till expiration or less than 10 days to expiration. But we're not planning on holding this all the way to expiration. One reason is there's there's a decent chance of early assignment on these guys here. So what I'm going to do is this. I'm going to do a put. We'll do puts in this case. And I'm going to tweak this just a little bit. Let me go to butterflies. Where's butterfly? There's butterfly. May 2nd, I'm going to go to 480 as my middle strike here on this. Okay, so there we go. And my lower strike, I'm going to go down a ways. I'm going to go down a ways. I'm going to go down to 450. My upper strike, I'm not going to tweak it that much. I'm going to go up to 490 here. Now, notice what's happened. This is now a credit. One way to think about that is this. This 450 is so far out of the money, this is almost like a back ratio spread right here. Just looking at those two, that's basically a back ratio spread. Now, it is a butterfly because this is still in there, but in terms of the pricing on this, it's affecting the pricing so that this is actually no longer a debit transaction. We're still going to call this a long put butterfly, even though it is a credit, just because our two middle strikes are the middle strike are short and the outer wings are long. But what is the Analyze tab going to say about this? Let's go and let's click on Analyze. Let's go to Risk Profile. Oh, come on. Was I not? I thought I was on the Analyze tab. I guess not. Okay, let me right click. Let me analyze the trade. Let's go to Risk Profile. There we go. Okay. Now, does this look like the other? No, this does not look like the traditional butterfly. But notice what happened. We said, and the stock right now is up here right now. We expected it to drop more into this range. Notice what happens if it drops into this range. That's good. It's more profitable in that range. What if we're wrong and the stock goes up? Underlying stock goes up, or if it even stays where it's at. We're actually profitable here in this. Notice that blue line is above our break even right there. So this is a trade. Now, that's great, right? The risk isn't on the upside. That's great. If it goes down, that's great. What's the catch? Remember, there's no free lunches. The catch is because our lower strike is so much, it's going to give us a possibly greater loss there on the low side on this trade there. Okay, so that's the problem. That's the problem there. If it goes against us, so we'll definitely want to put in an exit point on the downside on this if this goes down too far. Okay, so where's our break even is around 467, maybe something like that. That doesn't really matter to get that exact, but that gives us a range there of kind of where things to go. Where's our max loss? 450. Let me do this. Let me just shrink this down a little bit. Go up there. Where's our lower strike? 450. It is not a coincidence that our max loss is at 450 and our lower strike is at 450. Now, it's not going to hit 450 immediately if the stock goes down that far, probably at least, because there's the time element of this. But in any case, there's that. And what I'm going to do is I'm going to go to trade. Now, also, just remember this. You can play around with it. If you want to modify this a little bit, if you want to shift this a little bit, just move your strikes up or down just a little bit. Okay. And if I move this 450 up to, say, 460, what does it look like? That's what it looks like. Our loss is going to be less there on this. If it goes down far enough, but our credit is going to be a little less too, because we're having to pay more for the higher strike put on that case. Okay. So yeah, there you go on that. Let's do our trade here, and feel free to play along in paper money. You can tweak those, and I'm going to copy trade. Actually, let's see. Let's go to our trade tab. Okay, and We're going to put this in, and I'm just about out of time here, folks. But there's my trade. I'm going to right click, and I'm going to probably put in we'll put in an exit here, right click. I'm actually not going to have time to put in the full exit here, but where am I going to put in the exit? I'll put in the exit if we break below our lower area, about 471. I'll do that as soon as the show ends. I don't need to exit on the high side because it's great if it goes to the high side. Remember, doesn't matter the high side. We're making money up here, even if it goes way up there. Okay. All right, everybody. That's long butterflies, long call butterflies, long put butterflies. You could have done this as a call, but remember, if we did it as a call, those would be in the money contracts, increasing the chance of early exercise. We try and avoid that typically. Thanks for joining me, everybody. Coming up next, we got ThinkScript studies. Coming up at 4 o'clock Eastern time, we have market movers. And we will all see you same time next week. Bye-bye, everybody.